I could never be a short seller. I just don't have the balls for it. And I like to think I'm not stupid enough to short sell companies which are likely going to succeed. Hello, my friends. Welcome to the channel. Great to have you with us. I'm Sam Evans. You're watching the Electric Viking. Nvidia and Tesla have led over 250 billion US dollars in short seller losses during the recent market rally. $250 billion in short seller losses. I mean, in fact, Tesla's stock has had a pretty surprising rise, especially considering their weak performance in Europe, especially considering the constant negative media attention. But yet, investors aren't buying into it. The market's rapid bounce back to near record highs over the past month has been very unkind to investors who have bet against US stocks. I actually spoke about this recently. I said a lot of money has moved out of the US market and was going to the European market, which doesn't make any sense. I'm sorry. If you're from Europe, guys, I love Europe. Traveling in Europe is great. Investing in Europe, not so much. The European situation right now, the truth is their companies are less profitable than American companies on average. Anyhow, from the market bottom on April 8th through May 20, short sellers lost more than $250 billion. Imagine that. Imagine that being someone making these bets. That was according to data from S3 Partners. All of the Magnificent Seven stocks were among the top 20 names on which short investors lost the most money. In particular, they lost around $20 billion combined on Nvidia and Tesla. So, Nvidia and Tesla have benefited from individual catalysts throughout the run. For Nvidia, easing trade restrictions have been a boost for the AI chip leader headed into its next earnings release on May the 28th. Meanwhile, Tesla stock has rocketed higher as Elon Musk has said he's going to stop focusing on the Department of Government Efficiency, which I think he should quit. But anyway, he's saying he's going to stop focusing on it, or focus less on it, focus more on actually running Tesla, which is a good move. Maybe. I mean, when I say maybe, I think it is possible that another CEO could do a good job as well. Anyhow, the short squeeze hasn't just happened in large cap tech names. It's been a core theme of the most recent market rally over the past several weeks. Short sellers were also hammered in popular retail trading. And basically, really, there's been some big losses in Palantir and Hims and Hers. They totaled more than 2 billion. Short sellers in the Bitcoin-focused company strategy lost more than 5 billion. And interestingly, stock prices of Chinese EV companies have slumped. And the reason they've slumped is primarily because of BYD. I know this probably sounds like I'm going after BYD, but it's actually true. BYD has released what I think are too aggressive price cuts. I think this race to the bottom it's getting too aggressive, discounting 25 different models of car. I'm not talking about 25 different models of one car. I'm talking about 25 different types of cars that BYD sell by 10 to 34%. It's too aggressive. And obviously BYD are doing this because their dealers have too much stock, having to clear the stock, but it's putting the situation in China, it's putting it in peril. Investors are saying, well, companies are not going to be able to make money if you continue discounting cars constantly over and over. So shares of Chinese automakers marked a second day of decline as fears of a price war and increased scrutiny from regulators have weighed on investors. Hong Kong listed shares of BYD fell as much as 4% on Tuesday, continuing losses recorded in the prior session. The plunge of more than 9% on Monday was a reversal of its record high last week as investors assessed the Chinese electric vehicle giant's price cuts. Investors are concerned that the majority of BYD's cars are being sold in China, and if BYD are cutting the prices this much, they're going to be losing money on the cars they're selling. Not all of them, but at least some of them. Stocks of other Chinese automakers as a result also fell because they've got to compete with BYD on Tuesday as investors turned cautious about stiffer competition in the sector. Geely, their shares declined by 3.16%, although I think Geely are probably still a good buy. Great Wall Motors, they were down, and Li Auto lost 1.1%. Great Wall Motors down 2.37%. XPeng stock was down 1.7%. That XPeng, probably my two picks right now would be XPeng and Geely. I think that they are the companies XPeng and Geely are the really strong automakers that are growing very quickly. And if I was investing, that's where I'd probably be looking at putting my money right now. I'm talking about Chinese stocks here, by the way, not just all your money. I mean, it's a little risky to be like these, crazy people who put all their money into one stock. But I think diversifying is probably a good strategy right now. Artificial intelligence is where I'd be looking at. EVs and artificial intelligence, if you're wondering. Reuters reported Tuesday that China's Commerce Ministry was meeting industry bodies and automakers over a practice of marking cars as sold to meet sales targets. These zero mileage cars were then sold by thousands of vendors on the second-hand market. Separately, BYD announced on May 23 that it was reducing the prices on 22 electric, actually 25 electric and plug-in hybrid models until the end of June. And, this is getting to the point of being quite aggressive. Now, do I think these Chinese automakers stock will bounce back? I do. Immediately? No, because the truth is immediately these car companies will have to react to what BYD is doing. If they don't, they lose market share. This is unfortunately a zero-sum game. But here's the other thing worth considering. It's probably really the legacy automakers in China that are going to struggle the most because they're being disrupted. They're being disrupted in a big way, and they don't own their own businesses. They only own 50% of them. These legacy automakers, 50% of them, in fact, all these companies, they're all joint venture partnerships, and most of them are making internal combustion cars. So they're the ones going to be really struggling because the truth is the Chinese consumers, most of them don't want those old cars. I think these Chinese automakers will actually be able to disrupt legacy automakers, but they are still going to be looking at a very challenging few months as a result of this discounting practice. So guys, very interested to see what's happening here. A stock rebound in the United States, a bit of a decline in China. Both markets, I think, will probably, after the next few months, after these Trump shenanigans are finished, I think they're probably going to rebound, both of them. And we're going to see a pretty positive this year for economic growth. That said, I'm not an economist. Tell me, guys, what are your thoughts? Let us know in the comments. Bye-bye. Tesla's car sales in Europe are in. The Tesla Model Y has been on sale now in Europe for more than a month, and yet these sales numbers are absolutely not what I personally expected. Guys, I'm really curious now to know what your thoughts are because now we've had time for the dust to settle. It does appear something is going on in Europe. Hello, my friends. Welcome to the channel. I'm Sam Evans. You're watching the Electric Viking. It's worth pointing out here, guys, EV sales in Europe this year have actually grown significantly. That's why I'm kind of shocked to see these numbers. Well, maybe not shocked, but I'm surprised. Tesla sales plunged in Europe in April, including an 81% drop in Sweden, which could be based on deliveries, not actually orders. But it does mean Tesla sales hit their lowest level in 2.5 years in Europe, which data showed this week, as Europeans are actually buying more Chinese EVs, some of them XPengs, and some protesting against CEO Elon Musk and his outspoken views.